Welcome to The Explainer. Today, we're jumping into a financial tool that's known for being incredibly flexible, but also for carrying some pretty major risks. We're talking about the contract for difference, or as you probably know it, the CFD.
So here's the game plan for this explainer. First, we're going to nail down what a CFD actually is. Then we'll get into how you can trade, whether you think the market's going up or down. After that, we'll explore leverage. It's the thing that makes CFDs so powerful. And that leads us to the most important part, the risks. And finally, we'll wrap it all up with the key things you absolutely need to take.
All right, let's kick things off with a question that gets right to the heart of it all. How in the world can you trade on the price of something like gold or oil or a currency without ever, actually owning the stuff? The answer to that question is exactly what a CFD is. Okay, let's dive into Section 1. What is a CFD? We're going to break down this core idea and make sure we're all on the same page.
So, CFD, it just stands for Contract for Difference. And honestly, at its core, it's a pretty simple agreement. It's an agreement between you and your broker where you both agree to exchange the difference in an asset's price from the second you open the contract to the second you close it.
And here is the absolute key thing you have to understand. You are never, ever buying the actual thing. You're not getting a barrel of oil delivered to your door. A CFD is what we call a derivative. It just mirrors the price of an asset, so you're just trading the change in its price. That's it.
All right, so now that we've got a handle on what a CFD is, let's talk about how you actually trade them. One of the most powerful things about CFDs is that you can speculate on a market going down just as easily as you can on it going up.
This is what traders mean when they talk about going long or going short. It's super simple. If you think the price of something is about to shoot up, you go long. You buy a CFD. But if you think the price is about to tank, you go short. You sell a CFD. It gives you a way to trade no matter what the market is doing.
And really, it doesn't matter if you're betting on a price rise or a price fall. The way it works is exactly the same. Your profit or your loss is just the difference between the price when you got in and the price when you got out. Simple as that.
Okay, now it's time to talk about the feature that gets so many traders excited about CFDs, but it's also the very same feature that makes them so incredibly risky. Let's get into leverage. So what is leverage? Well, think of it like your broker is giving you a short-term loan. It lets you control a really big position in the market using only a small amount of your own money. And that small deposit you put down, that's called a margin.
And this is where it gets really interesting. A tiny deposit, your margin, lets you control a much, much bigger position. What that means is your potential profits, and as we're about to see, your potential losses, they're calculated on the full value of the position, not just that little bit of cash you put down at the start.
You'll usually see leverage talked about as a ratio, something like 50-1. All that means is for every single dollar of your own money that you use as margin, you can control $50 worth of the asset. And some brokers offer way higher ratios than that, which, you guessed it, pumps up the potential reward and the potential risk. Okay, please pay close attention, because this is without a doubt the most important part of this whole explainer. Just as leverage can blow up your gains, it does the exact same thing to your losses. And this is where CFD trading can get really dangerous if you don't know what you're doing.
Let's be crystal clear about what this quote is saying. Because your trades are leveraged, a tiny price move against you can completely wipe out your entire deposit. But it might not even stop there. You could end up owing your broker more money than you ever put in your account to begin with.
And this risk gets even worse because of something called gapping. See, in really crazy, fast-moving markets, the price can suddenly leap from one point to another, with no trading happening in between. Now, if the price gaps against your trade, your losses can happen so fast that they blow right past your deposit, leaving you with a negative balance that you are on the hook for.
Phew! Okay, so we've covered what a CFD is, how the trading works, and the immense power and the immense danger of leverage. Let's bring this all home and boil it down to the absolute must-know points you need to remember.
So if you forget everything else, just burn these 4 points into your brain. 1. A CFD is a contract on price, not ownership. 2. You're just speculating. You don't own the asset. 3. Leverage is a massive double-edged sword. It amplifies everything. And 4, and this is the big one, you can lose more money than you start with. And that really brings us to the final question, doesn't it? Is leverage a powerful tool, or is it just a dangerous gamble? Well, the line between the two really comes down to knowledge and managing your risk. Understanding that leverage cuts both ways, magnifying your gains and your losses equally, is the single most important step you can take in the world of CFDs.